AMD is the top subject of today's video. Okay, so AMD here today, this morning, got downgraded at Wolfe Research as firm expects slower GPU revenue growth. We're going to go ahead and react to share my opinion and perspectives on what Wolfe Research is basically saying here. We're going to run through this and we'll talk a little bit about that. Then I want to react to this one. This actually came out 2 days ago, about 48 hours ago or so. AMD was basically initiated coverage by Loop Capital with a buy rating. So I want to go through what they're saying, kind of give us a bullish and bearish take here, okay? So we'll speak about AMD a little bit at the top of this video, okay? From there, I want to react to this one. Tom Lee last night went on CNBC, spoke about not only inflation, but he spoke about where he thinks the best stocks to buy are for 2025, the best places to position in 2025. So looking forward to react to that one. And then this one, looking really forward to getting this one. Dan Niles, a very high level discussion here around NVIDIA, around Mag 7 stocks, around some of the best opportunities in the stock market he sees for this next year. So I'm definitely looking very forward to reacting to that one. It's actually really good. I already watched this previously. It's a really good clip from 11 hours ago here. So yeah, got a lot to go through. Appreciate y'all joining me as always. Thank you so much for being here. All I need from you guys, one thing only, for you to smash that like button. I hope you can take 1 second out of your day right now and just hit that like button on this video. Additionally, if you want to subscribe here to the channel, you can certainly subscribe. We are now at, oh gosh, how many subscribers do we have on this channel now? 70,000 or 71,000, something like that. Like, it's a big number. So I appreciate y'all for being here. We're on the path to 100,000. Additionally, if you're an AMD shareholder, you might want to consider joining my private stock group. We have a lot of AMD shareholders in there. We're always having a lot of high-level discussions around what's going on with AMD and whatnot. So if you're interested in joining, not only for AMD, but for all the other discussions the 6, 7, 8-figure members and myself have all the time, as well as access to all my course curriculums, that will be pinned comment down there. You can click on that, fill out a form. We'll see if we can get you in there to join us. It's always a lot of fun, okay? So AMD downgraded at Wolfe Research as firm expects slower GPU revenue growth. First off, let me say this. I do think this is important to say this right from the beginning because I'm a new AMD shareholder. Like, I just started buying in the stock very, very recently, right? But I definitely see a sentiment that people are sick and tired of these analysts coming out and downgrading AMD. I see a lot of comments, people like, man, they're downgrading us again and downgrading again, right? And it goes in this whole advanced money destroyer, they call it, right? And all those sorts of things. So, I can't speak for the people that have been in AMD for the past year, 2 years, 3 years. I'm just coming from my perspective. Somebody's been in the stock for like a month, right? AMD was in focus on Thursday as investment firm Wolfe Research downgraded the semiconductor company, citing slower data center GPU revenue growth than previously expected. Quote, as we highlighted following our visit to Asia last month, so talking December, we think the setup into earnings is difficult for AMD. Now, first thing is, the first sentence anybody writes in regards to a stock, always really important because it's going to tell you kind of the framework of how they're thinking, right? This is a very short-term call, is it not? We think the setup into earnings is difficult for AMD. Okay, as a long-term investor, I don't really care. I just care that AMD's revenue is going to certain numbers, net income's going to certain numbers over the next few years. I don't care if it's a difficult setup or not, right? Original design manufacturers' build plans suggest only modest quarterly growth this quarter from fourth quarter 2024 run rates. We estimate data center GPU revenue in the $1.5 to $2 billion range for the fourth quarter and $7 billion for the calendar year, that's CY calendar year, based on those checks. Well below buy-side expectations of $10 billion in our prior estimates of $10.8 billion. We model $1.75 billion in data center, that's DC, data center GPU revenue in the first quarter 2025 and flat quarterly growth for the balance of the year. The analyst also lowered his rating on AMD to peer perform. So basically he's just saying it's going to do as well or as bad as the semiconductor stocks do, right? From outperform, and removed his price target. His price target was $210. Isn't that up 80, 90% from here? Tell me if my math is wrong. I think my math is correct on that. Isn't that 80 to 90% upside from where the stock is today, right? Crazy. In addition to potentially weak data center GPU revenue, the analyst said he expects slow PC seasonality, continued weakness in gaming, and essentially no recovery in embedded, at least for the first half of this year. Despite those negatives, the analyst said AMD's upcoming launch of its MI350 AI accelerator should be significant catalyst when it launches later this year. It should be huge in the back half of, certainly 25 into obviously 26 and beyond, right? He said he expects it to be noteworthy redesign and upgrade compared to the recently launched MI325, which only increased memory loading compared to AMD's initial MI300. Now, do keep in mind, AMD is going to continue to innovate and come out with new chips pretty much quarter in, quarter out. And I don't want to say quarter in, quarter out. I mean, they're going to probably launch some sort of chip almost every single quarter, right? But as far as the big data center GPU related type chips, those are probably, at least once every year, right? They're going to keep pedal to the metal and keep pushing forward on that. So, that's not going to slow down anytime soon. No, in terms of them coming out with new chips. No, at the end of the day, when I look at this, right, this sounds to me, what does it sound like to me? It sounds like exactly the same things everybody's been complaining about AMD. Oh, they're taking longer than we wanted them to take to ramp data center chips, right? And AI chips. And so, revenue is only going to be, it sounds like the same exact story we've heard time and time again recently in regards to AMD. And as a long-term shareholder, I just don't care anything about that. I just don't care anything about that. I believe AMD is extremely well positioned, especially in inference over this next several years. Because you got to understand, right now, there's a lot of training going on with these GPUs, right? And so NVIDIA is phenomenal for training. Not to say NVIDIA is bad for inference and not to say AMD is bad for training, right? It's just if I kind of view it the way Lisa Su views it, right? She views, at the end of the day, kind of reading through the tea tree leaves here, she views NVIDIA as being the phenomenal chips for training these AI models. But she believes, from what I hear, that inference is actually going to be much bigger opportunity long term. And she believes AMD is the most well positioned for that, which means AMD could benefit massively from that really over the next 10 years. Like we could say AMD's not, their Super Bowl is not even right now. Like you could make an argument that right now is NVIDIA's Super Bowl, right? Like this is NVIDIA's time to just absolutely tear it up and dominate. But you can make a strong argument that AMD's Super Bowl isn't actually until 26, 27, 28. Like we're still, a while out. That doesn't mean AMD is not going to grow. Certainly AMD is going to have phenomenal growth, right? But the other thing I just kind of push back on here is just this kind of very short-term thought process about like, are they going to meet the numbers or hit the numbers or beat the numbers the next quarter, right? Because at the end of the day, I love to look at 1000X and I love to pull up the charts feature and look at on trailing 12-month basis specifically, right? Because quarterly is not going to tell you really the story. Trailing 12-month basis really going to tell you the story. It's clear as day we have started an uptrend in regards to AMD getting their revenue growth back on the right track, right? Clear as day. But the thing that's more impactful is, we're using our data provider here in compiling analyst estimates. It's very crystal clear that AMD is going to likely be growing and growing and growing and growing for years, not months, not quarters, years to go in the future. I like to be part of companies that are going to likely have years of future growth, right? And so, once again, I look at this time period as not a time to be selling AMD. I look at this time period as a time to be a buyer of AMD. Like I've never been a buyer of AMD ever. And for me to say now's a great time to buy AMD, it's got to be something here that is pretty darn compelling, and this is pretty darn compelling to me. Now, AMD also got initiated coverage from Loop Capital here, and they said they had a buy rating. So what's going on with Loop Capital and why are they bullish on AMD? So AMD was on the spotlight on Tuesday, and once again, this was 2 days ago, as Loop Capital initiated coverage of Dr. Lisa Su's led company with a buy rating and a $175 price target. Remember, the other guy had a $210 price target on the stock, right? You know what else it makes me think, to finish off with that last guy? Sometimes I wonder if an analyst like that is embarrassed. Serious. You have a $210 price target on a stock, you think it's going to 210, and the stock just keeps going down and down and down, and then it's $110 something, right? Eventually, you might get embarrassed. You might get pressure from, the top down on you saying, what's going on here? How you got a 210 price target on it? It's not, this stock's not even getting anywhere close to your price target here. And I feel like sometimes these analysts feel like they got to make these short-term calls because, I don't know, maybe their job's on the line. I don't know, or they're embarrassed or things like that, right? Because that analyst had his 210 price target for probably quite a while, and obviously it didn't come true. And obviously we know where the stock is today. It's got to be tough for those type of folks, Shares of AMD have traded more in line with peers with dominant revenue exposure to mature end markets. Examples are PCs, smartphones, industrial, says Gary Mobley wrote in a note to clients. Quote, in our view, shares should more accurately reflect some degree of success in accelerated computing. Examples are GPU-based data center compute, XPUs, etc. The market share expansion opportunities in general purpose compute within PC and general server market. The latter has become more front and center in recent months given the tribulations at Intel. Yeah, Intel's a whole situation there, right? Delivering a bit deeper, the analyst said there are several investor debates going on with AMD right now, including whether it's actually a beneficiary or casualty of artificial intelligence and accelerated computing. I agree, that is like a big debate that's going on right now. Is everybody trying to figure out, is this going to be a huge boom for AMD over the coming years or a huge bad thing for AMD over the next few years, right? With Moore's law coming to an end, and some believe it already has ended, performance gains for processor are getting harder and harder and may be non-extinct at 4 nanometers, 3 nanometers, and 2 nanometer nodes, the analyst wrote. AMD is at the cross-section between the changing system hardware architecture of general-purpose compute and accelerating compute, the analyst said, adding that investors are wondering whether AMD's progress in GPUs for data center will be enough to offset the general-purpose CPU server market. Other questions include whether NPU-based edge AI apps can boost the replacement cycle for PCs, if AMD can exploit Intel's woes and gain share in both PC market and CPU general server markets, and to what extent ARM and its licensees encroach on the traditional CPU market, right? Yeah, whenever you're talking about custom chips for especially a lot of big tech companies, right? That's going to be a market, but you got to understand this chip market is so incredibly massive. It's ridiculous. It's incredible, right? The TAM here is in the hundreds of billions of dollars. Like, it's not like this is a small market. So, that's the thing people don't understand. There's plenty to go around for NVIDIA, for AMD, for companies like ARM, for companies like Broadcom. There's plenty to go around here for everybody, right? Our view, we're talking about these big tech companies are spending tens of billions of dollars a year on these chips, right? And honestly, they got to continue to put that money up. Our view is that AMD will prove more triumphant in these market shifts versus what the equity market seems to give the company credit for. Mobley also noted that investor sentiment is quite low, for sure, due in part to its weak PC sales. Additionally, investor expectations for AI GPU sales in 2025 may have come down from $10 billion to $8 billion, analysts. Yeah, sounds like it. The other guy was in the sevens, right? Nonetheless, the analyst said that AMD will be able to take an additional 10 percentage point of x86 CPU market share from Intel by 2028 in both PCs and servers, while ARM will grow slower than most expect. That's an interesting prediction. Lastly, AMD should be able to grab 20% of data center GPU market by 2028, with custom AI only accounting for roughly 15 to 20% of the market and NVIDIA controlling the rest. Based on these assumptions, it is possible for AMD to generate $55 to $60 billion in fiscal year 2028 revenue, and at a high 50% gross margin. AMD could have 11 to 11.50 in non-GAAP EPS. Yeah, and if the stock, let's say in 2028, fiscal year 2028, if they're doing $11 at EPS, how do you value a company like that? You're going to value it probably about 30 times, is my guess, as long as AMD still had top line and bottom line growth of 10% plus. So you'd probably slap a 30 multiple on that, which puts the stock in the low 300s, right, come 2028. Which, once again, if we're talking about a stock in the low 300s come 2028, and it's a stock that's in the 110s today, it's a huge W. And that's why I say, folks, Sell me every AMD share they can sell me right now. I will gladly buy them. If they want to sell them to me at 130, 120, 110, 100, 90, I don't care. Give me your AMD shares. I'll gladly take them off your hands because I believe AMD is going to $300 to $500 over the next few years. And so all this mumbo jumbo about one quarter might be better than the other and this and that and this and that, it's all going to be irrelevant over time, in my opinion. All that matters is that AMD is now going to go through a several-year growth cycle as a company, right? Top line and bottom line. And when it comes to margins. And when you could talk about a company trading, remember, AMD is not trading at some super high multiple. If AMD was trading at a super high multiple, if you look at AMD's forward P on this stock, right? If it was trading super rich, I'd be like, but look at the forward P is 26 on this stock. 26. Are you flipping my flapjacks? Like, that's not bad at all. Like 26 forward PE for AMD, give it to me. Like, come on. Like that's not crazy at all. If AMD was trading at a 56 forward PE or 76 forward PE, I feel very different, right? I'd be like, it's priced in a lot of the future growth that's coming here. We haven't even priced in almost anything, in my opinion. Like, this is just value in the company based upon if they had mid-single digit growth over the coming years. And I'm like, I think their revenue growth and EPS growth will be a whole lot higher than single digits over the coming years, right? So once again, I look at AMD and I see a pretty incredible opportunity, in my opinion, because I think this next many years is going to be pretty darn exciting. So that covers AMD. Alrighty, let's listen to everybody's favorite bull, Tom Lee, talk about where he expects the best opportunities in the market to be, and then we'll get into Dan Niles and a lot of market talk, and also where he thinks the best stocks to position into for 2025 are.
Track Global Advisors Tom Lee, a CNBC contributor. Welcome back.
Great to see you, Scott.
All right, first, your view right now on this market is what?
I think that markets are showing some...
Oh, by the way, congratulations to Dutch Bros shareholders. If you hold Dutch Bros stock, let me know in the comments section. I don't know how many people watching this hold Dutch Bros stock, but congratulations. I believe Dutch Bros just very recently hit a new all-time high. I believe it did.
That CPI was dovish, and actually I think some of the inflation prints the last 2 days have been dovish.
Hey, you guys got my back. I'm going to support your companies. I got your back, okay? I'll get the Nike hoodie for my Nike shareholders. I'll get the Dutch Bros, okay? I'll drive the Teslas. Like, I do what I got to do to support you guys, man. You support me.
PPI, so it's setting the stage for yields which kind of were close to touching 5%. To kind of cool, and at a time when sentiment's been negative, I think we should be rallying.
Is the Fed back in the game? Which means this report was good enough, these two reports, really, as some are saying that, okay, you're not going to get a cut in January, but you could get one in March, and some people had written cuts off for many, many months.
Yes, into this CPI print, the whisper number for core CPI was over 0.3, so the market was bracing for a really hot number, and you could see it in the Fed Fund futures where as of yesterday, there was a 30% plus chance of a Fed hike. I think those sort of extreme views have been quelled. And I just think generally, without accounting for the fact that the California fires could mess with inflation, the inflation print over the next 3 months is going to be a lot lower than what we saw November and October. And remember, January to March of last year, it was close to 0.4. So I think inflation is setting up for some good comps.
Okay. How optimistic are you for the type of return we could do this year after back-to-back, 20+% gains for the S&P?
We've gotten some good harbingers so far because the first 5 days of this year, the S&P is positive. So I'd say there's an 80% chance of something over double digits for the year. And what's going to matter to a lot of people is how we do for the month of January. But as of January 15th, we're up 0.7%. So those are good harbingers for the year.
Can we have a good year if the Fed doesn't cut until later in the year and bond yields remain elevated for a while?
If bond yields get stuck here, it is a severe tightening of financial conditions. And I think it's going to hit housing, and we're already seeing it now. So I think it is important for yields to move directionally lower.
That's a long way.
It feels like we got a ticking time bomb situation going on here, right? We all know Trump gets into office, obviously, in the next few days, right? It feels like a ticking time bomb in terms of when Trump gets in office, a showdown with Powell, right? Where Trump probably tries to force Powell to lower interest rates, right? especially in that first 6 months of him being in office, and maybe Powell and the Fed pushing back against that. It feels like there's a showdown setting up. We'll see, but it definitely feels like there's a good old cowboy showdown coming here.
Stocks will not be good if bond yields stay where they are now.
Yes, it's going to test the market's resolve. I don't think it kills equities, but it's hard for someone to be pounding the table if they think yields are going to be stuck at close to 5% for the next 6 months.
Wow, so if yields, let's just say they stay near where they are now, you wouldn't be as optimistic as you are?
I think it's going to raise concerns there's a policy error from the Fed, that either financial conditions are too tight or the bears will argue the Fed made a mistake cutting too aggressively last year.
Isn't this the base case? I mean, you have what is arguably a more inflationary environment because of some of the policies that are being talked about by a new administration. Sure, they may stimulate more economic growth, but with that potentially comes more sticky inflation too.
Well, there isn't necessarily a connection between growing faster and more inflation. There is some inflation that can be generated by tariffs, and that's the uncertainty.
But that's what I mean also. It's like tariffs, it's inflating the deficit. It's just reinflation. It's the reinflation trade based on some of the expected policies that may cause that.
True, but to keep in mind, last year's inflation, first of all, a lot of last year's inflation was what they call imputed because it was just statistically catching up to the price changes of the years before, but it's housing and auto insurance were 80% of the inflation over the last 4 years. And the third is labor market.
By the way, if you're wondering why Hershey stock is struggling, the main reason, from my understanding, is Coca. Coca's gone crazy, man. You look at the price of the Coca, who's up there?
Which we know aren't in an inflationary position. So in order for new policies to generate inflation, they have to be powerful forces that fiscal spending hasn't generated the last 3 years. So I'd say that it's difficult for me to make the case inflation's getting strong.
Okay.
Yeah, I mean, inflation seems like it wants to be... Inflation seems like it's setting up to be maybe a 3 heavy year in 2025. Meaning essentially it feels like for much of 2025, inflation will be in the 3s. Probably between 3.1 and 3.5 is my guess. That's kind of what it feels like, right? Which is not at the Fed's goal of, 2, but you're not out of control.
So you're going to be sitting on quite a bit of cash in a very strong US dollar environment. So you've got a great currency behind you. You've got some money to deploy. Are you tempted by some of the other sectors around the world? Does Asia look cheap to you, or some parts of Europe? Is there anywhere you're thinking of deploying your cash outside the United States?
Yeah, I mean, we actually took some positions in emerging markets because we think all the rhetoric and all the fear around Donald Trump and tariffs, it's funny when you hear people just sort of take him at his word at, oh my God, he's going to put 60% tariffs on China or whatever. And then they panic. And then you figure out, well, he's a businessman. And you've already had 4 years of this where that's a starting point in negotiation. And where you ultimately end up is typically a lot better than that. So to your point, Mark, if you look at the relative valuations around the globe, yes, on a going forward basis for 12 months, the S&P is sitting at about 22 times or so. But if you look at some of these other markets, you've got the Nikkei sitting at about 19 times. You've got the Indian stock market sitting about 20 times, but the China stock market is sitting about 13 times. So a lot of these other markets have underperformed for the last 2-3 years. They're very cheap for obvious reasons. People are afraid of tariffs coming out of President Trump. But I think to some degree, and you saw that with some of the moves since the beginning of the year, is maybe they're a little bit overdone. And so that's where I'm looking, because the valuations, to your point, as you brought up, are a lot more compelling there. And then also in the U.S., the markets have really been driven by 7 stocks, the Magnificent Seven. And I think there's going to be an AI digestion phase. And we've been writing about this now for several months. And you're seeing signs of it from some of what Microsoft has said over the past month, which we can get into. But If that trade starts to fall apart, and given you've got 7 stocks that are somewhat tied to the AI trade that are driving the U.S. market, that are 35%, let's say, of the S&P 500, and are trading at valuations in the low 30 times range, then you've got a huge problem potentially, and that money could also flow into these foreign markets that are a lot more hated, where the valuations are cheaper.
Dan, we'll pick up on AI and chips slightly later. Just to pick up on what you talked about, deploying your assets in markets, in Asia, emerging markets included. You talked about that low valuation in China. And as you said, it's low for a reason. Is it
So Niles and myself, we don't always see eye to eye, but there's a lot of times, I'll be honest, him and I see eye to eye, right? For instance, last year, he was heavily invested in Meta and Amazon. Guess what? 2 of my top 4 positions are in the public account. Meta's my biggest. Amazon, I believe, is my 4th biggest, right? So, and then also, what have I been talking about for a while? Like, specifically with NVIDIA. Growth rates are going to definitely slow substantially, at least in my opinion, in the back half of 2025, right? And that's going to be kind of a moment for people to kind of figure that out. And I think people are already starting to figure that out, even though it hasn't happened yet, right? But based upon kind of what NVIDIA stock's been doing, it looks like people are kind of catching up to what I've been talking about for several months, right? About that cycle that's coming there, where it's going to be a major slowdown. And people are going to be like, whoa, okay. Because then people are going to start to run with conclusions about, is NVIDIA going to go negative on revenue? All those sorts of things will start to be talked about, right? Even if they don't come true and they don't come to fruition, it will just start to be subjects. They'll freak people out, right? Oh man, could NVIDIA's revenues go negative? Because we know several times in the past, NVIDIA's revenues have actually gone negative. And so people will start having those sorts of discussions thinking about 2026, right? So that's going to be a whole digestion cycle like he speaks about. And so we definitely see eye to eye on that.
enough for you right now to be pumping money into that market?
Yeah, I mean, we own some stocks in there, but the thing with China, which makes it difficult, is 2 things. They've talked about in the past where handing out checks directly to consumers, they view it as a form of welfarism, rightly or wrongly. And they don't want people to get addicted to that. So you don't get this overstimulation that you've seen in markets like the US in particular, where they were handing out checks for people unemployed, or in Europe. And so you don't have that big bazooka effect, for lack of a better term, that will drive valuations and markets up on euphoria. And so any kind of recovery is likely to be a lot more measured. The second big problem, quite honestly, is the same one Japan suffered through for decades, which is there's only 2 real ways to grow the real economy, right? There's population growth, and then the productivity increases on that population growth. Well, in China, for the first time in 60 years, the population went down, and based on the
3, pump massive amounts of money into your, but then he said real, to be fair, but I'm just like, it could also grow that way too. Oh gosh.
Traffic trends, they're probably going to go down for the next decade at least. And so much like Japan had to suffer through that, unless you get a massive increase in productivity, which given some of the restrictions on technology coming out of the US, it's hard to believe. Those are some of the things you're going to have to struggle with. So for us, we picked cash as our top pick, but we have 4 other names. 2 of them, Cisco and Adtran, are sitting in the telecom services space. We like the mid-cap stocks today. One of our other top picks, which is KBWB, which is the bank ETF in the US, that benefits from deregulation and tax cuts. So there are other names that we like in the US. We're just saying that it could be a very volatile year. And don't be surprised, and that's why we don't have a Magnificent 7 in that group of 5, which we've always had 1 or 2 stocks in there. Last year, for example, we had both Meta and Amazon in our top 5 picks. We don't have one of those names in there this year because we do think there's some real AI digestion risk, and there's better places to deploy. And all of those names I mentioned, mid-cap value, the bank ETF, Adtran, Cisco, those other 4 names, they all have very compelling valuations relative to their peers or the market.
You like mid-cap?
It always is interesting to see, like, societies over time, like viewing, let's say, people having kids as like a bad thing, right? Like China had their one child policy for the longest time, right? That was a whole situation, and like it was like demonized if you had a bunch of kids in China, right? And it's just like crazy for me to think about that, because it's like people having kids is the best thing for the economy. It's just like there's no debating that. Like of course it is, right? Like if you want to grow your economy, you want to grow your nation, you want to grow your country, like what are you going to do? Like you need more people, right? Like if I had a choice, would I rather there be 330 million Americans or 660 million Americans? As an American that has a business, I'd much rather have there be 660 million Americans than 330. If we had 660 million Americans instead of 330, my YouTube views would probably be twice as high, right? I'd probably have twice as many people to sell 1000xstocks.com to. All that stuff, right? Like all my companies, all my stocks I own would have double the amount of consumers. And if you would just say, even if the GDP was the same, or not the GDP, GDP per capita, if you say the GDP per capita was the same, right? The average incomes were the same, right? It's just a massive amount more people to sell to. So yes, like, it's always interesting, because I'm like, if anything, I think countries should be encouraging their people to have children. Not, if you look at almost any society where they start to go into population decline, it's not a great thing for that country. It's not a great thing, man. It's the way it is.
Why not small caps? They also have compelling valuations.
Well, it's a great question, Heslinda. The big reason's the following. If you think about what I'm worried about, which is the Fed having to raise rates potentially as you get towards the end of this year, small caps struggle in that environment because they just happen to be smaller. And so a rate environment that's more beneficial to them really helps them out a lot more. And also, if the economy is slowing down, they don't have as much revenues to cover the fixed costs. If you look at the mid-cap space, by definition, they're mid-cap, right? So they're a little bit bigger. They can handle a tougher operating environment. But that's also why we say it's mid-cap value, not mid-cap, because mid-cap growth has also benefited from the same trends that have driven the overall market. And that's why we're saying mid-cap value is more interesting, because the S&P 500 over the last 5 years, if you think about it, first, it was a couple of years of investment during COVID because everybody's going online. So you have all this internet infrastructure spending happening. Then for the last 2 years, it's all been about AI. And so the S&P 500 over the last 5 years is up 82%. The mid-cap value space has underperformed that by 35% over that period of time and trades at a 17 multiple, not the 25 times trailing multiple that the S&P 500 is trading at. So, and you've seen this during 2022 when the Fed was hiking really fast, and quite honestly, during 01-02, when you had the tech bubble break, which if it gets really bad in AI, I don't think it'll be that bad, but it could happen. That also held up very, very well. And so in a tougher environment, they also hold up nicely. And things like tax cuts and deregulation help the mid-cap names more than they're going to help the S&P 500 names, where they've already got low borrowing costs. They're huge. They don't care as much about that.
Hi, Dan, it's Mark again. You were talking about the potential risk of an interest rate hike in the States. Well, we've got one very much on the radar here in Asia. There's a lot of talk that the Bank of Japan could be raising interest rates next week, of course, from very, very low levels. Now, that may well give some support to the Japanese yen. Do you think that will work out in some way as a positive? People will be more attracted to Japanese markets because of a stronger currency, or is that going to be something which breaks the sentiment? There's been a lot of money rushing into Japan over the past couple of years. Is it good or bad if they have an interest rate hike next week?
Mark, you frame that beautifully. I mean, I always say it's never the data. It's the market's reaction to the data, right? Because if I tell you, hey, inflation's going to go up 6% over a year, you may go, oh my God, that's terrible for markets. Except if it's 2021, in which case the S&P went up 27%, right? So I think it'll actually be good for Japan because the reason they're having to raise rates is maybe faster growth, some inflation. People really hate deflation, and Japan's been struggling with that for decades. And so I think in Japan's case, with the support, as you rightly pointed out, for the currency, if I were to bet, I think it's going to be more supportive for their economy versus negative. And so that's kind of how I would think about it as it relates to Japan specifically. The valuations, because the market has rallied so much from the lows, it's not hugely compelling at 19.
That's like a flash crash right there, man. Look at that move down. So dramatic, right? And then it just got right back to where it was supposed to be.
Versus, the China market sitting closer to 13 times, but it is lower than the S&P at 22. And obviously a lot, the AI companies for the most part are all sitting in the US. And so foreign markets by definition have struggled because of that. And the dollar, as you pointed out, relative to...
You don't play the Chinese markets or the Chinese stocks. Here's the issue. Those Chinese stocks and the Chinese indexes, they always look cheap versus US peers. Always looks cheap. Always looks cheap. Always will look cheap. Unless China makes some massive changes with transparency, with being much, much more business friendly, especially the top companies. Trust gets built a lot more. Like, outside of that, it will always trade at a significant discount to the US markets, and so won't Chinese stocks.
And the dollar by itself has gone up from 101 at the end of Q3 to about 109 at the end of Q4. And so that's put tremendous pressure on anything that isn't US based, right, for that reason. And so we'll see what happens going forward. But I think the way you framed it was perfect.
Right.
And I tend to be more on the bullish side on it.
Dan, this is a theme in the tech space, isn't it? I mean, that's what we're seeing with the Max 7 as well. They just keep bidding up the valuations.
Yeah, absolutely. And quite honestly, for the last couple of years, that's been the right thing to do because the AI trend has been so strong. But I think what investors should be concerned about is if you look at the biggest spender by far on AI CapEx, it's Microsoft. And part of that is obviously Microsoft has a 49% economic interest in OpenAI, which started this whole AI theme, which with their introduction of ChatGPT at the end of 2022. And Microsoft's CapEx has been growing at 70 to 80% year over year for the last 6 quarters, if you include December. But on January 3rd, they came out in a blog post and said, we're going to spend $80 billion on CapEx in their next fiscal year, which ends in June. Mm-hmm. But if you go and do the math, they already spent $20 billion in September quarter. They guided that up for the December quarter. And so you go, well, wait a minute, that means there's more than $40 billion in the first 6 months of fiscal 25, which means they're going to spend less than that in the next 6 months after growing 70 to 80% year over year for the last 6 quarters. So if you're any kind of chip company that sells into Microsoft or any of these other big hyperscalers, I think you're going to see dramatic slowdown in revenues by the time you get to the middle of the year. And by the way, that's what you saw after all that investment during COVID. Because don't forget, NVIDIA, which is the poster child for this trade, their revenues before COVID were negative year over year for about 3 quarters. And then COVID hit, and then the revenues surged to being up over 80% year over year by the beginning of 2021. Because we're all locked up, right? We're all going online. Then once we all get unlocked, those revenues went from up over 80% year over year to down over 20% year over year. The stock got crushed, went down over 60% during that move from peak to trough. And then you got the AI trade and you're back up to these levels. But I think you're going to see another slowdown after growing for 2 years over 100% year over year in revenues.
Dan, NVIDIA is not in your top 5, but that doesn't mean you can't still make money with NVIDIA. A lot of the guests that we've had on the show say that it is a must in your portfolio.
The one place I'll push back on the negative side for NVIDIA is just because the companies, might not be growing as fast, let's call it by the back half of 2025, 2026, 2027, doesn't mean necessarily the company's going to go down on revenues. So I think if you're trying to price in revenues are going to go negative like past periods, I would be careful about that. And the reason being is NVIDIA keeps launching these better AI chips. It's going to likely be year after year after year. And since we're in kind of a AI war over this next number of years, these companies are going to have to keep upgrading, right? So maybe they won't increase the CapEx as dramatically, but they still might have to increase at some point in time, right? And so, yeah, just be careful about betting NVIDIA revenues going negative. I feel much more comfortable about maybe betting that their revenues end up evening out, maybe even more in the 10 to 15% range longer term, right? Obviously, 25 is still going to be a really nice growth year for NVIDIA revenue-wise. But then after that, I would kind of think about NVIDIA, maybe let's call it 10 to 20% revenue growth for the next number of years after that. AMD is a little different though. AMD, I really view that as a 20+% revenue grower for the next number of years, right? Because remember, AMD is playing a lot of catch up here in regards to this, where NVIDIA's pulled forward a massive, monumental amount of demand.
Know that it's risen 800% over the last 2 years. There's still money to be had, right? Even if it's not going to be at the pace that we've been seeing in the last 2 years.
As I said, the last time you had to go through a digestion phase after COVID, NVIDIA's stock went down over 60%, 60 from peak to trough. Right now, forecasts are for NVIDIA's revenues to grow over 50% this year. I don't think it's going to be even close, because if you think about it this way, if your biggest customer is Microsoft and it's going from growing their CapEx 70 to 80% to basically zero in 6 months, you've got to think through that, because all of these big hyperscalers, they kind of move together to some degree.
Sure.
And so if Amazon and Google, et cetera, see Microsoft spending slowing down that much. And by the way, it's slowing down for a good reason, because you're spending all this money. But the question is, have you seen any return on that investment?
Have you seen any return on investment? But yeah, that's going to happen with all of them. All of them are going to slow down. It's going to start in 25, and it'll slow even more in 2026. That does not mean they're going to stop spending. They're going to stop buying these chips, right? No, that's not how this works. But it will be a significant slowdown over the next 2 years in that spending, right? And the spending on CapEx could end up being much more in line with revenue, or maybe slightly lower revenue. So the way I would think about it is, let's just use Meta as an example. Let's say Meta is growing an average of 15% revenue per year for the next number of years, right? Which is a pretty fair number to consider Meta growing 15% a year revenues for the next, many years. So if that's the case, maybe Meta grows, CapEx in future years by 15% also. Or maybe they do a little less. Maybe it's like 12% or 11% or something like that, right? But in terms of this crazy CapEx cycle where it was far outpacing revenue, I think that's coming to a close on that chapter over this next 1 to 2 years. And then I believe it's going to be more in line with the company's revenues going up, or less than what the company's revenue. So then if you got a company like Google, it might be growing 11% per year revenue. Maybe they start only growing CapEx by 7% or 5% or something like that, right? So that's the way I would view it.
So if you think about Microsoft in particular, especially given their relationship with OpenAI, when they reported the June quarter, they guided revenues below consensus for September, despite CapEx expectations going up. Then when they reported the September quarter, they guided revenues below expectations for December, despite CapEx expectations going up. So at a certain point, if you're not seeing the return, you're going to slow down that spending. And by the way, that goes for the other big guys as well, which is why I think you're going to see CapEx slow for the industry as a whole, from growing 50 to 60% down into a 10 to 20% range. And I think NVIDIA, I would be very careful on that stock this year. Now, it doesn't mean over the next, 3 years, 2 years, you can't see still growth. But I don't think anybody wants to go through a 60% loss like they saw after the COVID hangover. And you could see some very big downward revisions, especially when forecasts are for 50% growth for NVIDIA's revenues in calendar 25. So that's why I think you have to be very careful of all of the AI-related stocks, because if NVIDIA gets hit and there's an issue, everything's going to go down.
Yeah, I would be careful betting against, thinking NVIDIA is going to go down 60% from here. I think that's really hard to do. In order to do that, you would have to have market crash on top of that, like you did with the Nasdaq in 22, On top of that, you have to have their revenues go significantly negative, right? I think that's going to be hard to do, to get their revenues to go literally negative, okay? All right, guys, appreciate you joining me as always. Thank you so much for being here. If you're looking to apply, join my private stock group. That will be pinned comment down there, access to all my course curriculums, access to my AMD chat, NVIDIA chat, all the other stocks and whatnot. Unbelievable community, 6, 7, 8-figure investors. So if you're ready to take things to the next level, pin comment down there, fill out a form. We'll see if we can get you access to that maybe the end of this week or maybe next week at some point in time, okay? All right, guys, much love and have a great day.